New Holdings Ltd. is currently trading at $13.98 per share, representing a strong intraday gain of 2.34% as trading volume accelerates on the New York Stock Exchange. While a quick look at this daily swing might suggest simple market optimism, the reality underneath this price action is far more complex and completely unappreciated by the retail crowd. Just a few days ago, the company announced that its Mexican subsidiary officially secured a full, unrestricted banking license from regulators, clearing the way for a massive $4.2 billion capital deployment program designed to capture the unbanked population of Mexico. Alongside this, the board authorized a historic $1 billion share buyback program. The immediate expectation from the public narrative was that this massive structural win would automatically rocket the equity straight back toward its previous high marks. However, the reality is that the stock has struggled with intense macro resistance, down nearly 20% year-to-date as institutional players quietly recalibrate their positions. This stark tension between what the public expects from a hyper-growth digital financial giant and the cold reality of regional credit risks forms the exact battleground where fortunes will be decided in the coming quarters. Investors looking at the broader landscape are trying to figure out if this expansion is an undeniable buy signal or a dangerous trap, a question that requires moving past surface-level headlines to analyze the raw mechanics of their balance sheet. The general consensus floating around popular investing sites and digital forums is that New Holdings is an unstoppable juggernaut that will inevitably replicate its massive Brazilian success across the rest of Latin America. The public narrative says that because they successfully acquired over 60% of the adult population in Brazil, doing the same in Mexico and Colombia is just a matter of copy-pasting their digital formula. But when we challenge this assumption with a deeper look at macroeconomic reality, a completely different risk profile shows up. Mexico is a fundamentally different market than Brazil. The cash-dominated economy, entrenched legacy banking giants, and distinct consumer credit behaviors mean that a $4 billion bet could see significantly compressed margins before it yields any meaningful return. Retail investors utilizing basic self-investing tools or scrolling through their retail individual brokerage accounts often view this enterprise as a fast casual tech play, similar to how they trade high-flying tech assets like Nvidia stock or Apple stock. In reality, this is a banking entity tied to the consumer credit cycle of developing markets. It requires a sophisticated understanding of net interest margins, provision for loan losses, and regulatory capital requirements. If you treat it like a pure software company, you are completely missing the structural tailwinds and headwinds that dictate its actual book value. Looking closely at the recent price movement, we have seen a dramatic tug-of-war between short-term retail momentum and long-term institutional accumulation. The daily trading volumes have consistently spiked above 70 million shares, showcasing intense liquidity and heavy interest from institutional funds that manage high-conviction portfolios. Over the past month, the stock managed to carve out a 12% recovery from its summer lows, signaling that institutional accumulation might be forming a solid floor around the $11 mark. However, this recent recovery is fighting a broader macroeconomic headwind. The global financial markets have been highly volatile, forcing investors to re-examine how they approach an online investment in international emerging markets. While many people use their Fidelity trading platform or use the Fidelity mobile app to access global financial equities, the institutional flow reveals that big asset managers have been rotating capital out of high-beta emerging market assets into safer domestic value positions. This rotation explains why, despite pristine operational growth metrics, the stock price has faced such severe resistance whenever it attempts to breach the $15 threshold. When looking at institutional data feeds accessible through an interactive brokers platform, we can see that while major investment houses maintain an overweight rating, they are not chasing the stock upward. Instead, they are using algorithmic limit orders to build large stakes during sudden intraday pullbacks. For any retail trader managing their own self-investing strategies through a standard individual brokerage account, understanding this institutional behavior is crucial because it shows that the big players are playing a patient game, refusing to let public hype dictate their entry points. This brings us to how modern market infrastructure shapes the trading dynamics of this specific asset. Millions of retail market participants now execute their strategies across various online investing platforms. Whether someone is using the Robinhood app for its simplicity, analyzing options chains via the interactive broker's trading system, or managing long-term assets within Fidelity IRAs, the structural access to international growth equities has never been greater. This massive democratization of market access means that retail sentiment can cause massive short-term daily swings. For instance, when the news about the Mexican banking license broke, retail traders using Robinhood stock trading features rushed into fractional shares, creating a massive opening print spike. Yet those using more complex setups, like the interactive brokers platform or executing large-scale blocks through Fidelity Wealth Management, were simultaneously filling sell orders to take quick profits, dampening the retail-driven rally. This tension shows the deep divide in expectations. Retail traders expect immediate gratification and a straight vertical line upward, while institutional systems view the stock through the lens of long-term risk-adjusted returns, factoring in the interactive brokers' fees and currency fluctuations between the Brazilian real, the Mexican peso, and the US dollar. Comment below how many shares of new holdings you currently hold in your portfolio right now, and let me know which platform you use to trade it. This distribution of shares between aggressive retail accounts and patient institutional vaults will ultimately determine how violently the stock reacts during the next earnings cycle. To fully understand where the price is going next, we have to analyze their recent earnings performance and how the market reacted to those numbers. In their last major quarterly report, the firm showcased stellar revenue growth, clearing over $5 billion in a single quarter, alongside massive net income expansion that beat several legacy banking peers. However, the stock experienced a sharp temporary sell-off immediately following the print. Why? Because the market's expectation was so unsustainably high that even an excellent report failed to satisfy the whisper numbers on Wall Street. The reality is that their provision for credit losses increased as they expanded their credit card and personal loan books in Brazil. This expansion of credit is highly profitable during economic upturns, but under global macroeconomic pressures and elevated interest rates, it raises the specter of rising non-performing loans. Investors tracking the financial sector through Fidelity Investments or analyzing diversified baskets like Fidelity ETFs and Fidelity mutual funds know that credit quality is everything. If a digital bank grows its loan book too quickly without strict underwriting standards, the eventual defaults can wipe out years of accumulated net interest income. This exact concern is what short sellers have been weaponizing, creating a persistent layer of short interest that keeps the equity capped. Meanwhile, aggressive growth investors using platforms like SoFi Investing or managing automated portfolios through a SoFi robo-advisor view these credit provisions as a natural, healthy cost of acquiring market share in an underbanked continent. This divergence in analytical frameworks creates the beautiful, volatile trading range we find ourselves in today. Let us take a step back and look at the underlying machine that drives these financial metrics. Founded in 2013 and headquartered in São Paulo, Brazil, the firm set out with a clear, direct mission to eliminate the massive fees and customer service issues that defined the traditional Latin American banking sector. At the time, a tiny oligarchy of legacy banks controlled the vast majority of the Brazilian financial market, charging exorbitant interest rates on credit cards and demanding physical branch visits for the simplest tasks. The company countered this by launching a zero-fee Purple credit card managed entirely through a smartphone application. The response was a massive tidal wave of consumer adoption. Over the past decade, they expanded their ecosystem to include corporate bank accounts, personal loans, investment management tools, cryptocurrency trading, and even life insurance policies. By stripping out the massive overhead costs associated with maintaining physical brick-and-mortar branches, they achieved an industry-leading low cost to serve, allowing them to remain highly profitable while offering superior rates to their customers. This cost advantage is the structural moat that retail investors on platforms like SoFi or those engaging in active SoFi investing often point to when justifying the stock's premium valuation compared to traditional regional banks. The historical financial reports demonstrate an incredible compounding machine, moving from heavy structural losses during their early growth phase to generating hundreds of millions of dollars in pure net income today. As the business model matured, the company realized that relying solely on credit card transaction fees would not be enough to sustain its lofty market valuation. They systematically evolved into a full-scale financial ecosystem, introducing innovative savings vehicles known as money boxes, which incentivized millions of users to park their cash balances directly within the digital app. This move dramatically lowered their own cost of capital, providing them with a massive pool of cheap retail deposits that they could then deploy into high-yield interest-earning assets, like personal loans and credit lines. This internal funding loop is exactly what sophisticated traders look for when analyzing banking equities through an interactive broker's